Hi, this is Paramdeep from Pristine, and in this session we'll move forward with the implementation of the integrated financial model. If you remember, till this point of time we have been able to create almost the full financial statements as far as the P&L and the balance sheet is concerned, right? So if you remember, we started the historical profit and loss account and the historical balance sheet. All these blue colored fonts that you see are historical P&L and the balance sheet. Post that, we created the revenue drivers and the balance sheet drivers, essentially the historical growth rates and the historical number of days of inventory, etc. Then we projected these numbers in future, as in we made some assumptions regarding the P&L and the balance sheet, the growth numbers. Then we projected the revenue, essentially price multiplied with the volume. Then we projected the cost, again price multiplied with the volume or as a percentage of revenue. Then we projected our P&L in future, this black colored font that you see. Post that, we came back to the balance sheet and projected the balance sheet in future, right? So for example, using the number of days of inventory, we got to the actual sort of inventory that we were going to store with us. There were three things that were cutting across the P&L and the balance sheet. So for example, we had the asset. So in our balance sheet, we had the asset that flowed into the P&L in the form of depreciation. In the balance sheet, we had the debt that had the interest component in the P&L. In the P&L, we had the profit after tax that flowed in the balance sheet in the form of shareholders' equity or the reserves in the form of retained earnings, right? And now we come to the actual reality of life. That's basically cash. Is that okay? So now we are going to create the cash flow statement, and whatever is the cash that's there at the end of the year would be flowing from the cash flow statement to our balance sheet in the form of a current asset called cash. Is that okay? So, but before we start creating the cash flow statement, let's first of all review what cash flow statement is all about. Is that okay? So, please note that now we are moving away from the accrual accounting. Now we are coming to the actual cash accounting. Is that okay? And please note that in business or in finance, cash is the king. So first of all, a little bit about the cash inflows. As I've been speaking from the beginning, there are three kinds of activities that a company can do. First and the most important is the operating activities, right? So as far as the operating activities is concerned, anything that's related to sales, that's related to production, that's related to the actual operations of the company. The core business of the company is called an operating activity. So if the company purchases equity, right? If the company purchases inventory, for example, if the company has purchased raw material that it's not yet used, so there is an increase in inventory, right? That will definitely lead to cash outflow. Is that okay? So payable, if there is an increase in accounts payable, right? If there is an increase in accounts payable, right? That is like a cash inflow to you, right? So, and if there is a decrease in accounts payable, so for example, let's say you bought inventory. Let's say you bought inventory on credit, right? For let's say $100, right? So what happens is that the material is in your store, right? So for example, there is your factory and there is your supplier. So he sends the material to you. You have not yet paid this $100. So what to tell him is that I will pay $100. But there is no cash outflow. Tomorrow you might decide not to pay. That's called credit worthiness. But when you pay, so for example, he knows that. So he has a bill. He has raised a bill and sort of you have told him that you will pay him $100. When you pay him $100, that's like a cash outflow to you. So at the point you did not pay this, you had an account payable of $100. When you pay these $100, the accounts payable go down, right? They become $0, and your cash goes down. So sort of your cash has gone down by $100. Out here your inventory was up. Out here your inventory was up by $100 and your accounts payable. So inventory is basically a current asset that you own, right? And account payable is a current liability that you own. So your inventory goes up in the form of current asset and your current liability in the form of accounts payable also goes up. When you make this payment, your account payable, which is a current liability, goes down and your cash, which is a current asset, also goes down. Is that okay? So your cash has gone down by $100. Is that okay? So if you were to summarize, then sort of everything related to operations we categorize as operating activities. Is that okay? Everything related to operations we categorize as operating activities. So so for example, any decrease in accounts receivable is like a cash inflow to you. Any increase in accounts payable is like a cash inflow to you. Decrease in accounts receivable is a cash inflow to you. I'm sorry for the mishap. Yeah. So similarly, a decrease in inventory, if you're selling your inventory, this is not really production, you have sold your inventory, it's like a cash inflow to you. If you have bought inventory, that's like a cash outflow to you. That's as far as operating activities is concerned. Then you have investing activities. So for example, let's see here, this is more logical in nature. Any purchase of fixed asset, right? So for example, if you buy a factory or a plant or a machinery, right? So obviously you have to shell out money for that. So there's a cash outflow related to it. Similarly, if you are acquiring a business, it's like a cash outflow to you. You have to pay this money to acquire the business, right? But if you receive dividends, if you receive interest, or if you sell off your plant and machinery, this is not going to be very regular in nature. This is not the regular business course, right? Then it's like a cash inflow to you. The third part is the financing part. If you issue equity or debt, it's like a cash inflow to you, right? If you repay debt, if you pay dividend, that's like a cash outflow to you. Please note that if you want to measure how good the business is doing, then the important part to note is the operating activities. Is that okay? So you have to figure out if there is enough cash coming in from the operating activities. Now, when we are creating the financial model, there are a few things to note out here. So any increase in assets, right? So from my balance sheet, if I see an increase in asset, right? This will simply imply that there is a cash outflow. Okay, it's as simple as that. If there is a decrease in asset, that's definitely cash inflow. Similarly, an increase in liability would essentially imply cash inflow for me. Is that okay? An increase in liability is like a cash inflow to me. Apart from that, you definitely need to remember that depreciation expense is not an expense. It is not a cash outflow. It is an allocation. Is that okay? Similarly, amortization or depletion of assets, loss or gain in selling assets, these have no impact on the cash. So if you see them in your P&L, you definitely have to add back these elements to figure out what the cash is going to be. Out here, I've already explained, if there is an increase in accounts payable, that means you have not yet paid out, that sort of increases your cash flow. If there is an increase in accounts receivable, that is like a cash outflow to you. Is that okay? So while creating the cash flow statement, that's the next step that we are going to do. We have to remember that if there is an increase in liability, that's like a cash inflow. If there is a decrease in liability, that's like a cash outflow. Is that okay? Similarly for assets, right? So if you are creating the cash flow statement for the first part, for the first time, I suggest that you simply link it to the balance sheet. Out here, let's start creating the cash flow statement. The first part of the cash flow statement is the cash from operating activities. Is that okay? So as far as operating activities is concerned, your profit is the first part that you should be concerned about. Is that okay? So let's start with FI06. As far as FI05 is concerned, we would not be able to figure out the change in working capital for FI05. So we'll start from FY06. That's column F. Let's link the PAT. So PAT I'll be able to find in the profit and loss account, right? So let me find FY06 PAT. I just link it to the PAT. Then then let's add the depreciation. Depreciation, please note, is not a cash expense. I'll again be able to figure that out either from the asset schedule or from the P&L. Let's link from the P&L only. I have the depreciation numbers linked in the P&L. So let's link from the P&L. Is that okay? I add the interest expense. So please note that interest expense is not an operating expense. It is a financing expense. So that has sort of a counter entry out here. So I add it there, I subtract it here. Is that okay? So because I want to find out the operating activity separately, so I go back and I add back the interest. So let's figure out where the interest is. If you remember, the interest is going to be here. So all are linked to F. Is that okay? Now let's get to the change in working capital. Now most of these items I'll be able to figure from the balance sheet. So increase in provision for employee fund. So let's go to the employee fund. Okay, I want to figure out an increase. So FY06 minus FY05. Okay, I add to it the increase in advances from customers. So I go back to the balance sheet. So advances from customers, this minus this. Then please note I have commissions payable, insurance payable, accounts payable, right? So commissions payable, insurance payable, accounts payable. So the three items are as such. I'll just copy it down. Is that okay? So let's figure out if this is right or not. Control back square bracket. Is that okay? Less E11. So this seems to be fine. Let's get to the inventory. Is that okay? So control page up, control page up. Let's figure out the inventory in a current asset. I have inventory, accounts receivable and loans and advances in this order. If it's the same in the cash flow statement, I'll just copy it down. I have it in the same order, so let's copy it down. So my net change in working capital is the sum of all the working capitals, or it is all equal to, and enter. Is that okay? That helps me figure out my net change in working capital. Right, so let me write a few of them. So I am getting my PAT from here. I am getting my depreciation from here. I am getting my interest expense from here. This is as far as the current liabilities are concerned. This is as far as the current assets are concerned. Please note that we have not taken a change in the cash right now, because cash is something that will derive from here. Is that okay? So that's as far as the cash flow from operating activities is concerned. If I want to get the net cash flow, essentially the cash that I get from, what I need to do is the cash that I get from my PAT, depreciation and interest, plus the net change in working capital. That's coming from the balance sheet. Please note that PAT etc. again can be found from the balance sheet. So PAT is the net change in the sort of retained earnings that I have. Similarly, I can find the depreciation from the balance sheet. It's going to be the change in accumulated depreciation. I can also find the interest expense if I know the debt from the balance sheet itself. That gets me my cash from operations. Is that okay? The company seems to be doing very well as far as the cash from operations is concerned. It's able to generate a healthy profit after tax. The net change in working capital is good, right? And I am getting a good cash flow from operations. That's very good for the company. So all I do is I copy it and take it to the right and just press enter. Is that okay? So overall I figured out 224, 237, 36, 291. There's a slight decrease in FY11 as far as operating cash is concerned, but otherwise the company seems to be doing very well as far as generating cash from operations is concerned. Please note that this is a very healthy sign for the business of the company. If the company is generating a lot of cash from its operations. That's the best that the company can do. Okay, so what we do next is that we come to the investing activities. So it asks for less capex, so all I do is less. I can go to the asset schedule and figure out the capex from there. I can also go to the depreciation, balance sheet, and get it from there. So this is my capex in this year, right? FI06, right? Add to it. So please note that I have used a negative sign in front of it. Is that okay? Add to it the gain or disposal from sale of asset. So gain or disposal from sale of asset. Is that okay? Less any increase in working capital. So I am looking for a negative sign, increase in working capital. I'll be able work in progress. I'll be able to figure out from the balance sheet. Let's take a look at the work in progress that we have. So I'm looking for FI6 less FI5. Please note that I have put a negative sign in front of this. Is that okay? Less increase in investments. So negative sign, my investments are again in the balance sheet. My FI6 investments less FI5 investments. That's it, right? So my cash flow from investing activities, I just add them all up. That's basically my cash flow from investing activities. Is that okay? In this case, it's pretty easy because the company is not getting into any complex investments. Is that okay? So I just copy this, I take it to the right and enter, right? So as you can see, there is a $500 million investment going from the company, and it's shown in a negative sign, right? So it says that the cash has gone out of the company. Let's come to the financing activities. So add any new equity raise. So let's go to the equity schedule. I have the opening balance. Add any new equity raise. Is that okay? This is the FI06 equity that I'm raising. That's it. Add any new secured loans raised. So secured loans will be in the debt schedule. Please note that there are multiple schedules. You can use any of these schedules to link. As far as the model is linked, there is no problem at all. So these are new secured loans, right? New unsecured loans. Again, I'll figure it out from the debt statement. So I have my unsecured loans, any new loans issued in FI06. These are primarily coming out to be 0. Again, unsecured loans repaid. Again, in the debt schedule, so my secured loans repaid in FI6. My unsecured loans repaid in FI6. Please note that you need to do this on your own, right? So please note that this is all with a negative sign. So let's put a negative sign. Please don't put these as zeros or constants because this is a fully integrated model. If you put in constants in this model, it will not serve the purpose of creating an integrated financial model. In any integrated financial model, all your statements and all your numbers except the assumptions have to be linked. Let's figure out the dividends repaid. So my dividends repaid would be there in the assumptions also. Let's take it from the assumptions. So this is my dividend paid in FI6. Interest expense, let's take it from the P&L. We have calculated in the P&L for FI6. Is that okay? So this is my net cash flow from the financing activities. Is that okay? Please note that interest expense is again a negative expense. This is again a negative number. Let's put a negative in front of this. Is that okay? Please note that these are all cash outflows and you have to clearly demarcate cash outflows from cash inflows. Please make sure that when you link, you link with the right sign. I am linking all cash outflows as negative. Okay, I am linking all cash out as negative. So I link cash out as negative cash. Okay, and I take all cash in as positive cash. Is that okay? It's very important to note this very carefully. Is that okay? So my net cash flow is basically from the three activities that I have, from operations, from investment and financing. So I take it from operations plus investments plus financing. Is that okay? That's my net cash flow. I take it to the right and enter. Yeah. So we have the net cash flow from all these operations, right? From all these parts. Now let's calculate the closing balance. Again, use the base rule. I have my opening balance of the cash as last year's closing balance. The net cash flow that I have is this for this year, and my closing balance is the opening balance plus the net cash flow that I have for this year. I just copy this to the end, and that gets me the cash flow, the net cash flow to the company. Is that okay? Now the easiest change as far as the historical statements is concerned is that my cash balance at the end should match the cash in the balance sheet. So I should have this equal to the balance sheet cash. Is that okay? For the historical statements for FY6. And this is coming out to be false. This is bad news for us. Right? Why is it coming out to be false? Right, now we'll have to figure out where the problem is. There could be a small problem of a slight error there, but that doesn't seem to be that in this case. So this minus this we can take should be less than 0.1. Still coming out to be false. Is that okay? So there seems to be some error there. Let's try to rectify that error. Please note that when you are creating these models, you have to make sure that all these checks and balances are in place. Is that okay? So let's review. I have PAT, I had depreciation, I add back the interest. Let's see if we have added back the correct interest we have from FY6. That's fine. All the F columns are linked to F columns. This is fine. Then I come here. This seems to be the error. I have less increase in inventory. Please note that unless you build checks in your model, it's never going to be possible to sort of build the model right the first time. So please build as many checks as possible so that sort of your overall model becomes very robust. If this is less increase in inventory, please take a negative sign in front of it. Is that okay? Similarly, there's a less increase in accounts receivables, so take a negative sign in front of it. Similarly, if there is an increase in loans and advances, take a negative sign in front of it. Right? So this is the net change in working capital that we have. I do think this makes sense. Let's figure out. It seems to be balanced now. So the balance sheet is balanced now, right? So, but let's take these three, Control C and Control V. Right, so my balance sheet is balanced historically. It is not yet balanced in future because we have not yet plugged in this number from my balance sheet to the cash flow statement. I'm sorry, we have to link the cash flow statement cash to the balance sheet. But there still seems to be some error as compared to what we have been doing till now. Because these numbers should match, right? So what could potentially be the error? Let's try to figure that out, right? So what we see is that we have taken the opening balance of cash as last year's closing balance of cash. Now the problem as I see it is that in FY05, in my balance sheet, I had a cash of $76 million, right? So that has to be there. So let's link this to the opening balance, the closing balance of FY05, because this cash is definitely outstanding with the company. Is that okay? So now let's try to figure out. One thing is that we have again. So this is showing as true. The simple reason being that that sort of it could be a negative number as well. So FI04, F44 less this could be a negative number. let's take the absolute value of this. Is that okay? ABS is a function that calculates the absolute value of this, so that even if it's a negative number, it's still taken care of. Let's take this to the right. Now this seems to be working as far as the historical statements are concerned. But still, for the projected values, the cash is not matching. We still need to figure where the problem could be. Now what you have to note is that this cash historically should match. Is that okay? Historically, the cash that I have derived from my cash flow statement should match that in my balance sheet, right? But for the future statements from FY10, my cash has to go from the cash flow statement to the balance sheet. Please note that there is a slight difference between two things. So historically and in future. So if I say historically, I can put a check. Okay, just like we checked and we found out that there is an error that we were making in our calculations. What we need to check is that my cash ending from the balance sheet should be equal to the cash ending in the cash flow statement. Right? There's a golden rule that we always need to check, right? Unless your cash is matching, your cash flow statement and the statements that you have created make no sense at all. But in future, where you are projecting these numbers, this check would not make sense, because what you're going to do now is from your cash flow statement, you're going to plug this cash back into the balance sheet. Is that okay? So what we are going to do now is that we're going to go to a balance sheet. Okay, we are going to go to our current assets, right? And from here, what we are going to do, from here what we are going to do is that link this back to the cash flow statement. Is that okay? Let's go to the cash flow statement and link it to the FY10 cash. Is that okay? All we do is Control C, Shift right, and enter. Obviously these numbers would match because you have plugged these numbers back. So as far as these numbers are concerned, matching of these numbers is not a useful check that you have. Is that okay? But matching of these numbers is definitely a useful check. Now let's go back to a balance sheet and figure out whether a balance sheet is balancing or not. Please note that even a balance sheet for historical as well as the projections that we have made is balancing now. Okay, so we have finally been able to create the financial statements that balance, right? The cash flow statement, the P&L and the balance sheet statement that are sort of correct and they are balancing. So let me summarize for you what we have been doing from the beginning for the various statements. So we started with basically understanding the case. So understanding the business scenario. Right? And then we did some back of the envelope calculations. The next thing that we did was basically build the historical statements. Right, so we built the historical profit and loss account and the balance sheet. So if you take a look at the model out there in the balance sheet and the P&L, all these blue colored fonts that you have, right, the historical numbers that you can see, these were all built as constants. Is that okay? The next thing that we did was we essentially built the drivers. So we built the P&L drivers and we built the balance sheet drivers. Out here we had the growth drivers, right? The year-on-year growth or the CAGR that we spoke about. And we had some of the costs as percentage of revenue, right? As far as the balance sheet was concerned, we had number of days of inventory, right? Of inventory, of accounts receivables and so on. Once we had built the drivers, we made the So if you see in this, in the assumptions part, we built the drivers. We built the historical drivers. right? So for example, this is a historical driver that we had. Then we made the projections about the future. So we made the assumptions about the future. Then we built the assumptions about future. Once we had made the assumptions, the next thing that we did was essentially build these numbers in future. So I built my assumptions. Right? From there, the next step that we had was essentially building my revenue. Right? So I had a revenue build up, then I had a cost build up, and then we projected the P&L. Is that okay? So this is the projection of P&L. Is that okay? Post building that, we projected the balance sheet. So using these drivers, etc., we projected the balance sheet. The next step that we had, so for example, we projected the balance sheet numbers. Next thing that we did was essentially there were a few items that cut across balance sheet, P&L, and the cash flow statement. Is that okay? So my balance sheet had an asset. So this was like my 8th step, and my P&L had a depreciation. So we built that. In my balance sheet, I had a debt, and in my P&L, I had an interest component. Then in my balance sheet, I had equity that was built using the profit after tax from my P&L. So this was like my step 9 and 10. Then as a step 11, I built the cash flow statement, complete cash flow statement. So if you remember, this is my equity schedule, this is the debt schedule, this is the asset schedule, and this is the debt schedule that we had. Then we built this cash flow statement in this particular tutorial, and we plugged the cash flow statement from my cash flow statement to the balance sheet. That's like step 12. Out here, my balance sheet is balanced. So some of the checks that I have is that my balance sheet is balanced. Okay. And my cash is matching historically. Is that okay? So these are the essential steps in creating a completely integrated financial model. Right now we have sort of reached a stage where we have a substantial amount of our model completed. It's a fairly integrated model, and it's a fairly complex model as well. What I suggest is that you sort of make sure that at this point of time you are up to speed with what we have been doing till now, and you can create these integrated financial statements. If you can create the integrated financial statements, then the rest of the model is going to be a cakewalk. Okay, so what I suggest is that you work hard and try to get to this stage of the financial model. It's going to be very important for you, and sort of it will give you a clear understanding of how to get an integrated financial model. As usual, if you have any questions, feel free to send an email to me on paramdeep@edupristine.com, or give me a call on +91 989 298 0608. I'll be more than happy to answer whatever questions you have, right? And I look forward to seeing you in the next tutorial. And in the next tutorial, what we would be doing is analyzing these financial statements and calculating the ratios. Post that, we would get into valuation. The first part that we would be doing is valuation through DCF, that's the discounted cash flow, and then we'll move to valuation by comparatives. Is that okay? I do hope that you are following the flow of these sessions. If you have any questions, as usual, feel free to send me an email or give me a call. I'll be more than happy to answer your questions. I thank you for your patience and look forward to seeing you in the next tutorial. Thank you.